It's very important for understanding the Fed's next moves. JP Morgan raised its global recession probability to 60%, up from 40%, estimating that the effective global tariff rate could increase by 22 percentage points. This bounce would make sense, especially considering the ongoing weakness in the US dollar. Welcome to this week's market analysis. I'm Isaac Martinez, trader and market analyst at xChief. In today's video, we'll review the key economic events and their impact on financial markets, followed by technical analysis of major instruments including the US dollar index, the SP 500, Euro USD, and Bitcoin. Let's take a closer look at the charts and explore the setups that could define the week ahead. This week we have several key economic events that could move the markets, so let's take a closer look at what traders should be watching. All the hours you are going to see are based on GMT plus 02. On Wednesday at 8 p.m. we'll get the FOMC meeting minutes. This report shows how the Federal Reserve discussed during their last meeting and can give us insight into future interest rate decisions. It's very important for understanding the Fed's next moves. On Thursday at 2:30 p.m., we have several inflation-related reports, starting with the core CPI, followed by the regular CPI monthly and yearly data. These reports measure how prices are changing for consumers, and they are important because inflation affects everything from interest rates to consumer spending. At the same time, we will also get the weekly unemployment claims, which show how many people are filing for unemployment benefits. This helps us understand how strong the labor market is. Then on Friday, again at 2:30 p.m., we'll get the core PPI and PPI reports. These look at price changes at the producer level, meaning what companies are paying for goods and services. Rising producer prices can lead to rising consumer prices, so traders watch this closely. Also on Friday at 4 p.m. we will get the preliminary University of Michigan consumer sentiment and inflation expectations reports. These tell us how confident consumers are about the economy and what they expect for inflation in the future. Confidence levels can influence spending behavior, and inflation expectations can impact how the market sees future interest rates. Overall, it's a data-heavy week that could bring a lot of movement in the dollar, stock indices, and gold. Stay alert and manage your risk wisely. Now let's continue with the most important fundamentals of the week. Wall Street ended the week with a sharp sell-off. The Dow Jones plunged over 2,200 points or 5.5%, marking its worst single-day drop in over 3 years. The SP 500 fell 5.9% and the Nasdaq lost 5.8%. The main trigger was China's announcement of a 34% tariff on all US imports, directly responding to the reciprocal tariffs recently unveiled by the Trump administration. This significantly raised fears of a global trade war and a possible worldwide recession. JP Morgan raised its global recession probability to 60%, up from 40%, estimating that the effective global tariff rate could increase by 22 percentage points, equivalent to a 700 billion tax hike or 2.4% of US GDP. UBS also cut its year-end SP 500 target from 6,400 to 5,800, citing weaker growth and mounting recession concerns. On the economic data front, US non-farm payroll surprised to the upside with 228,000 jobs added in March. However, February's figure was revised sharply lower and the unemployment rate ticked up to 4.2%, adding to economic uncertainty. Despite this, Fed Chair Jerome Powell said there is no need to rush rate changes, especially as trade tensions could push inflation up while slowing growth. It feels like we have time, Powell said. In tech, Apple shares dropped over 7% as the company faces higher production costs due to a 54% tariff on Chinese imports. Other China-exposed firms like Qualcomm, Caterpillar, Alibaba, and JD.com also declined. Meanwhile, GameStop surged 11% after CEO Ryan Cohen disclosed the purchase of 500,000 more shares, a strong signal of confidence in the company's future. Following the market turmoil sparked by the escalating trade war and China's retaliatory tariffs, all eyes turned to the Federal Reserve for potential relief. However, Fed Chair Jerome Powell offered no signs of urgency. In a carefully worded speech delivered Friday, Powell emphasized a cautious stance on monetary policy, stressing the need to keep inflation expectations anchored despite mounting political pressure for rate cuts. Speaking amid heightened volatility and renewed trade tensions, Powell acknowledged that the economic impact on tariffs is likely larger than expected, and warned that their inflationary effects could persist longer than initially thought. He made it clear that the Fed must ensure that rising prices from import costs don't translate into sustained inflation. Powell stated that the central bank is well positioned to wait to consider adjustments, reinforcing the idea that policymakers are in no hurry to ease policy, even as President Trump publicly urged Powell just minutes before the speech to cut rates, calling it the perfect time given falling energy prices and strong job growth. Powell did not directly address Trump's comments but firmly reiterated the Fed's independence and commitment to its inflation mandate. Markets, already weighed down by the prospect of a prolonged trade conflict, saw further pressure after Powell's remarks, with investors realizing that the Fed won't act quickly in response to market or political demands. Instead, any policy shift will be driven by data and the broader economic outlook. Powell's message was clear. While the risks are real, especially from persistent inflation tied to tariffs, the Fed is taking a wait-and-see approach. Let's now move on to the technical analysis, and as always, we start with the strength of the US dollar. The first thing we need to understand is what has happened over the past week. As we can see, the price has shown a strong downward move, clearly tied to recent developments, specifically the tariffs imposed by the US government. From this point on, it's important to determine whether this current recovery move could push the dollar back up towards some of the recent highs or to potential target zone. This could be levels where liquidity is building up or key inefficiencies might lie to the upside. And this means we should mark potential liquidity zones around 104.314 and 104.683. Now, if we discuss whether there are any clear unbalanced areas, zones of inefficiency or fair value gaps, at least on the 4-hour chart, we can't really identify any solid levels. The only imbalance we had has already been filled, so currently there are no relevant zones from that perspective. If the dollar continues recovering, we could technically aim for the previous bullish target around 105.301, which was calculated earlier. However, we can't rely on that target for now, considering the complex scenario the dollar is facing, unless we see some kind of strong fundamental news this week that might support for a real recovery. Unfortunately, as we've seen, there are no impactful economic releases expected that could trigger such a move in dollar strength. That's why for this week I'm leaning towards bearish targets. A key level I'd highlight is around 100.157, which could offer potential for a reaction. Another possible reaction zone is around 100.865, where we have a previous imbalance, but honestly, I don't see any significant area for a meaningful reaction before that. So it's possible we could see a short-term recovery in the dollar up to around 104.314 or 104.683 before continuing the downtrend. A fake out or manipulation to the upside is highly probable, only to then resume the bearish structure that has been clearly established with the US dollar. As for the SP500, the outlook isn't much better. We are only seeing negative signals. On the 4-hour chart, all the previous bearish targets we had key liquidity zones have already been hit, and I am talking about the zone located at 5,500, 5,400, 5,100. That means we now need to identify new liquidity zones going forward. The first notable zone is around 4,953, which is located exactly here, with additional potential areas around 4,920 here and 4,845 here. This week, as price could reach them and show some reaction, depending on market behavior. If price fails to reach those levels, unfortunately, we won't have any strong zones of attraction to work with, making directional bias more difficult. From a strategic point of view, when it comes to trading US indices, especially the SP 500, my personal approach remains bullish. I am focusing on buying opportunities and accumulation rather than selling or trying to catch extended downside moves. We've already seen significant drops, and sooner or later the S&P 500 is likely to form a solid bottom that could trigger a strong upside rebound. Now moving to the Euro USD, after reaching the top of that previously identified imbalance, which was here, we've seen a significant recovery for the euro, as of the bullish targets we had outlined have now been hit, and it's likely that throughout this week, if price continues to bounce off the 1.08844 level, what we identified last week as a key killer zone, we could see a continued move to the upside here. This bounce would make sense, especially considering the ongoing weakness in the US dollar. We are seeing strength returning to the euro, and if this trend holds, if the eurozone shows signs of continued resilience, we could see the euro gaining further ground against the dollar. As long as the bullish structure in the euro USD remains intact and this support zone holds, I believe there's justification to continue looking for buy opportunities in this pair. The new upside objective would be around 1.10875, focusing here at the top of the bodies of the previous candles in that area. On the downside, if we do start to drop, the bearish levels to consider would be 1.07783, 1.07332, followed by 1.065, 1.057, and 1.044 as potential deeper support zones. That said, I believe it would be quite difficult to see a sustained decline in Euro USD as long as the US dollar remains weak and the US economy faces recession risks due to recent policy decisions. Finally, let's wrap up with Bitcoin. We've seen a downward move where price has already swept two key liquidity zones we marked last week. The first one was here, located at 81,100, and the last one was here, $79,890. What's important now is how price reacts to this most recent liquidity zone. We're not just seeing price reach it, we are already seeing a bounce from around the 79,000 zone, which is located here, defined by this low. This zone is critical. Even though price didn't fully sweep the entire area, it's still important to mark it on the chart as it where the current rebound has started. Ideally, from here, Bitcoin should start forming a bottom. That would be the best case scenario. In other words, Bitcoin must not break below the $76,555 level. If that level is reached, the next downside target would be around $72,510, which we have mentioned in past analysis. But if Bitcoin holds above this area, $76,555 support, we could see a recovery with upside targets at $81,025, $83,967, and potentially $88,800. If we get a strong bullish move. Keep in mind when it comes to crypto, especially Bitcoin, which currently holds high market dominance, any bearish movement in Bitcoin can trigger even stronger drops in the rest of the market. So risk management is absolutely crucial right now to avoid unnecessary losses. Thank you for watching. If you found this analysis useful, make sure to give this video a like, subscribe to the channel and turn on notifications so you never miss an update. And if you want to start trading with a trusted broker, register today at xChief.com. I'll see you in the next video.